problem. How are you going to roll back this liquidity, especially at a time when you want the yields to be lower? You want the yields to be lower because there is a huge government borrowing program. The government borrowing program is likely to be higher because there are going to be vaccine expenses. You're giving subsidies to, even the champions, to the PLIs. They are the well-off segments. And of course, you have the other subsidies, some of which will have to continue. Tax collections need not necessarily be much higher. There could still be a challenge in terms of receipts. And therefore, it's likely that 2021 is going to be a more challenging year for Reserve Bank than 2020, the year when we saw the greatest ever contraction of 25% of the economy. But let's look at what experts think of the year that's going to be. I'm being joined by Anant Nageshwaran, who is also a member of the PMEAC, but a financial sector expert, as also Upasana Bharadwaj, who's a chief economist at Kotak Bank. Anant, let me begin with you. What's your sense? I mean, Chetan Ahya stands at minus 5.7 in terms of the economy this year, and the rest of the poll is indicating that we may be about 7 to 7.5 contraction. Can you say on Jan 1st that we are likely to get further upgrades, that the consensus will move towards the Morgan Stanley estimate?
Oh, I think first of all, good morning to you and to your readers and to your listeners, and Happy New Year to all. So I would say at this stage, the odds are more towards a further upgrade of this number, i.e. tending towards a slightly lower contraction rather than higher contraction. But I would say for planning purposes, we should work with 7% contraction in real GDP for 2021.
Okay. Well, Upasana, same question to you. I think even you have come down from a minus 10, 11% to a minus 7.5, if I remember right, is your number. What is your sense? The only fly in the ointment for me is overnight we got that core sector number, which after improving so dramatically in September and October actually fell, a little more in November. So would you say upgrades are in order for the growth number for the current year?
Lata, firstly, Happy New Year. Honestly, we have, of course, upgraded the GDP forecast earlier from a 11.5% minus to a minus 8.5%. That's where we stand today. Yes, there is a probability of a slight upgrade further, but anything beyond 7%, 7.5% looks difficult at this point. And just like you mentioned, October was a month for which we have, broadly, almost all the data. That is a year, that was a month also because of pent-up demand, because of festive demand. A lot of many things are working out. Now we are seeing a little bit of slack there in the recent data that is out. And of course, not to say a complete picture is still out, but it is a little mixed and patchy. So I would say that there will be a little bit of moderation from what we've already seen in the previous months. And that is where I would want to still reserve my view on any further upgrades beyond 7%.
Okay, well, now let me come to the more important problem for the Reserve Bank, which is inflation. Anant, we know that this has been a supply-related problem that India has had, and already I think most of the people for December itself are expecting a 5% inflation or thereabouts. But we are seeing a raging commodity inflation globally and an unrelented printing of money by the major central banks. So would you say that we are going to see, even if we see higher upgrades to growth, we are going to see upgrades to inflation as well?
No, I think that is quite possible, because you correctly pointed out in your initial remarks as well that there is so much of liquidity, and the fact that GDP growth estimates are being revised for the better for this year and for next financial year as well. I think the inflation outturn will be higher, and the fact that we have had higher than expected inflation in the course of this year, when there has been so much of contraction for the first 6 months of the year, does tell us not just the supply side bottleneck, but the fact is there are regulation-induced cost of production problems for most of the Indian small and medium businesses. And that is the reason why even in a year of demand compression, at least for the first half, We are facing a high inflation outturn, and that in fact does raise questions about continuation of the current inflation targeting regime with the numbers that we have.
Oh, yes. But from what the Reserve Bank governor said at the press conference and the subsequent note which came, the RBI working paper from Dr. Patra and another colleague of his, it seems like they're going to continue with 4% plus or minus 2. I mean, that's at least a hint. But Upasana, more generally, I mean, the MPC's target apart, look at I mean, we were just running the RBI balance sheet growth as Anant was speaking. And let's play those graphics again. Reserve Bank's balance sheet has grown by 33% if you see from December to December, which is about 14 lakh crore. 10 lakh crore has come from buying dollars. $126 billion has been bought. And about 4 lakh crore in terms of G6. Now, it's likely that it has to continue to buy dollars the way in which it is coming. So would you say RBI has a problem that inflation may not come down that quickly?
Lata, I would absolutely agree. There is a major problem of plenty at this point where we stand. So given the kind of liquidity that is sloshing around, both global and domestic, that's going to continue to remain a major challenge. Core inflation, despite all odds, food has its own ups and downs. But core inflation has been rather quite sticky and is likely to remain so. Commodity price inflation has already started. Rupee has not been allowed to strengthen as much. So, it's not offsetting any surge in commodity prices. And also, if you look at the September quarter that has gone by, it was the input prices which were really tepid, which really helped the corporates maintain their margins, etc. So as we go ahead, I think a lot of it is going to pass through into consumers, given the rise that we're seeing in input prices as well. So I think all of this taken together, there are rather very high significant upside risk to inflation, and that is going to pose a very significant challenge for RBI, especially because growth is, of course, picking up, no doubt, but there are pockets which remain extremely fragile, and that balancing act is going to be much more difficult at this point, given inflation is going to be high. We expect BOP to remain quite a lot in surplus again next year. And all of this taken together, liquidity, how to mop that liquidity back is going to become a challenge.
Okay. Anant, same question to you yet again. You think Reserve Bank will have a problem rolling back its balance sheet? How do you see the year ahead from a financial sector point of view?
So I should have made it very clear at the beginning, Lata, that I am speaking in my personal capacity and
of course.
not as a member of the Economic Advisory Council Minister. So I think, yes, I mean, it would be rather obvious to state that the Reserve Bank of India will have a problem, especially if economic growth does indeed improve to the extent that people are currently anticipating right now. But that, of course, that is a problem that the rest of the world will be facing. In fact, personally, I would be less concerned about the consumer price inflation outturn being higher than 4% or 5%. To me, that is inconsequential. It is consequential only because the Reserve Bank of India has a target of 4% plus or minus 2%. The real problem will be the asset price inflation and the exuberance it creates, leading to malinvestments, etc. So I would be more worried about overheating in the Indian economy in a much broader sense. And therefore, the question you posed about financial, the liquidity being managed properly, that to me is a bigger challenge than this question of consumer price inflation outturn being higher than expected.
Okay, I think our viewers who are listening to you should take this advice and this caution on board that the bigger danger is going to be asset inflation, because the Reserve Bank may have to continue to increase its balance sheet because of the inflow of dollars. Upasana, finally, how do you expect the fisc to pan out? There seem to be statements from the government that they will be more open about fiscal stimulus. What are you expecting in terms of the budget? Do you think they'll be less conservative than they were this year?
Yeah, Lata, see, we're expecting a nominal GDP growth of about 14% into next year. Now, it's also a function of what government really does, because, tax buoyancy is going to pick up for sure, but not to the extent where they can really afford a major stimulus. While I agree that government is signaling that they're open to more stimulus, but I think, in terms of expenditure, the prioritization is likely to continue because there's not going to be much room. We're looking at 5.5% of GDP as fiscal deficit for next year. With that, also, it looks difficult how the borrowing program is going to sail through into next year, especially given that most of the key investors are already sitting heavy on GSEC and also SDLs.
Okay, so you suspect there could be a rise in yields next year. What's your expectation? I mean, do we go up to 6.5 on the 10-year? What's the guess on yields?
Yes, so Lata, here two things I'd just like to mention. One is that I do expect some form of policy normalization to begin. So that is where
rate hike?
The shorter end of the no, not a repo rate hike, but yes, the operating target has to move towards repo. So effectively, what we are saying is that the short-term rates should be moving from, let's say, 3.20, 25 to a near 4% through the course of next year. Now, when that is going to happen, we're talking about the shorter end of the curve definitely getting elevated by a 60 to 75 basis up. Meanwhile, the far end, I think, yes, it's going to go up because of the supply pressure. We're looking at a 6.25 to 6.5 range as we go into the next year. But clearly, the outperformance will be of the far end because I think operation twist kind of measures will continue rather than outright purchases because clearly there'll be no room for that. So I would say that the far end may get slightly supported because of such special OMOs.
All right. So the important part is that we may not have reverse repo at 3.35. We should see it perhaps go towards 4. And there will be people already have a lot of government securities, banks. So that could also put an upward pressure on yields. But Ananta, if we are in a 2003 kind of situation, when when we were starting a big period of growth, which is what our equity poll showed, that we are likely to see a 30% rise in earnings next year on top of a 24-25% this year, then do you think we can stomach this? How are you looking? Would you agree that we are in a 2003 kind of start of a growth cycle?
From the macro point of view, I would say that most signs point to such a growth revival for the emerging market space, and partly because of the affirmation we have had from central banks in Europe and in the United States about their continued preference for extremely low interest rate and a high liquidity policy. So yes, but whether it really translates into the kind of corporate earnings numbers are already assumed for 21 and for year ending March 22, I can't comment on that because they do seem quite optimistic at 30% nifty earnings that you pointed out. From a macro, and I think it's always the case that in an extreme liquidity situation, that the asset prices do indeed run far ahead of the earnings improvement. So in that sense, notwithstanding the possibility that earnings could really pick up as much as being indicated right now, I would still be concerned about the asset price inflation, and therefore, more than interest rate policy, it is the combined macro-prudential policies of the central bank and the capital markets regulator that would be required for the course of the calendar year 21.
Okay. Anant and Upasana, thank you very much for joining in and putting in all the concerns that a financial sector investor ought to be worried about. Have a great year, both of you.
You too. Thank you very much.
Okay, so I just want to put on a table the points that our experts have made, that growth